With the U.S. markets now closed for the weekend, we are looking at one of the most bizarre and telling final prints of the week. Opendoor Technologies, ticker OPEN, closed Friday, November 7th, 2025 at $6.56 per share. The change on the day? Zero. An exact 0.00% move. After hours, it crept up just 3 cents to $6.59. Now, the immediate expectation when you see a 0.00% close, especially on a volatile tech name, is that it was a forgotten stock, a dead money day where nothing happened. But the reality is that this $6.56 flatline is a lie. It is the scar left behind by an all-out war. To understand what happened on Friday, you have to look at two things that flat number hides: the volume and the night before. An almost incomprehensible 214 million shares changed hands on Friday. That isn't a quiet day, that is a Super Bowl of trading. And all of that volume was the market trying to digest the bombshell that dropped on Thursday night, the company's third-quarter earnings report, which announced that Opendoor as we knew it is dead. The company is being refounded, in its new CEO's exact words, as a software and AI company. Friday's 0.00% move wasn't calm. It was the precise geometric center of a collision between two opposing 100 million share bets on that new future. The common belief about Opendoor is that it's a failed iBuyer. It's a company that tried to be a high-tech house flipper, a hedge fund, as the new CEO put it, that used algorithms to buy homes, hoping to resell them for a profit. And in a high-interest rate, low-inventory housing market, that model is a death sentence. For the last year, the narrative for anyone on their Robinhood app or SoFi Invest platform was that this was a company bleeding cash, stuck with homes it couldn't sell, and spiraling toward irrelevance. This is the expectation that sent the stock crashing in after-hours trading on Thursday night when the Q3 numbers hit. The headline figures were ugly: a net loss of $90 million, an EPS loss of minus 12 cents, which was worse than analysts expected, and guidance that Q4 revenue would fall 35% sequentially. The bears, in that moment, felt completely vindicated. But the challenge to that narrative, and the reason 214 million shares churned to a stalemate on Friday, was that the bears were selling the old company. The bulls were buying the new one. New CEO Kaz Nejatian took the earnings call and essentially set the old business model on fire. He was ruthless. "We're not a hedge fund waiting for macro to turn around. We're building Opendoor 2.0. He announced a hard pivot, cutting reliance on consultants, launching over a dozen new AI-powered products, and changing the entire goal from buy low, sell high to transact with more sellers. This is the core of the new thesis. Opendoor is now a software company that facilitates transactions, aiming to make its profit on volume and add-on services, not on speculative home price appreciation. This is why Friday's price action was so fascinating. The stock got hammered on Thursday night, opening deep in the red on Friday. The sellers were dumping their shares based on the $90 million loss and the bleak Q4 revenue guide. They see a company that is still burning cash with $962 million in the bank, and they see a $90 million quarterly loss as a death clock that is ticking. They see a company that is essentially insolvent in 2 to 3 years if that burn rate continues. But then an equal and opposite force of buyers stepped in. These buyers, the open army of retail traders and new thesis institutions, heard something entirely different. They heard the new CEO give a hard, measurable target. Opendoor will achieve break-even adjusted net income by the end of 2026. This is the first time the company has ever given such a concrete long-term profitability target. These buyers looked at the Q4 guidance and saw exactly what they wanted to see. Home acquisitions are set to increase by 35%, while revenue is set to drop 35%. This isn't a contradiction. It's the new model. It means Opendoor is successfully buying more homes but holding them for a shorter time, clearing out old inventory, which hurts short-term revenue and margins, and getting its turn speed up. This is a factory retooling its assembly line, and the 214 million share volume was the market fighting over whether this retooling will work before the cash runs out. So what does this AI-powered pivot actually mean? It's not just buzzwords. According to the CEO, it's about ruthlessly cutting expenses and automating everything. He claimed they're using AI to streamline sales contracts, reducing the number of employees touching a single contract from 11 down to just 1. They're building AI-powered home assessment tools and automating title and escrow. This is the Opendoor 2.0 thesis, a technology-driven platform, not a capital-heavy flipper. The goal is to make a smaller, more consistent margin on a much larger number of transactions, and then sell those customers higher margin services like title, escrow, and potentially mortgages. This is a massive gamble. It's an attempt to transform a business that is at the mercy of macroeconomics, like interest rates and home prices, into a software business that is more like NVIDIA stock or Apple stock, generating scalable, high-margin revenue from its platform. Of course, it is nowhere near that, but that is the dream being sold. And it's a dream that some institutions are, for now, skeptical of. Recent 13G fillings show that major holders like Vanguard and BlackRock have actually reduced their positions. This isn't a simple all-in story. The big money at firms like Fidelity Investments is watching from the sidelines or even trimming, while the retail crowd and a new set of believers are piling in, betting on this new CEO's vision. This brings us to the future outlook, which is one of the clearest binary bets on the entire market. This is a true race against time story. The bull case is simple. The new CEO is a wartime leader. He has set a clear 2-year goal for breakeven. He is slashing costs, refocusing on the high-velocity transaction model, and using AI to build a scalable platform. He has $962 million in cash, and he has a plan to get to profitability before that cash runs out. If he succeeds, this $6.56 stock is, without question, absurdly cheap. It's the kind of investment that traders on Interactive Brokers dream of catching at the bottom. The company is even trying to align with shareholders by announcing a special shareholder-first dividend of tradable warrants, which is a complex but direct way to reward long-term holders, and frankly a classic move to appeal to the self-investing retail crowd. But the bear case is just as simple and just as brutal. The number one risk is liquidity. A $90 million net loss in a single quarter is terrifying. That gives them about 10 to 11 quarters of cash at this burn rate. But the company is trying to accelerate acquisitions. That will require more cash. They've been funding operations through an at-the-market program, which means they're constantly selling new shares into the market, diluting existing shareholders. The bears see this not as a pivot, but as a desperate capital-intensive company in a horrible macro environment putting on a software costume to fool the market one last time. They are betting that the housing market, with its high rates and low turnover, will kill this company long before the 2026 break-even target is ever met. This is the ultimate expectation versus reality play. The market expected Opendoor to just be a dumber, more volatile version of the real estate market. The reality is that it is attempting a radical high-speed corporate transformation in plain sight. Friday's 0.00 close on 214 million shares was the market's declaration of total, perfect indecision. It is a stock perfectly balanced on a knife's edge between a $20 AI winner future and a $0 bankruptcy. Comment below with your take. Do you believe this is a real AI-driven pivot, or is it just a cash-burning iBuyer in a new disguise? In summary, that $6.56 0% close for Opendoor is the most dramatic flatline you will ever see. It represents a 214 million share battle that ended in a perfect draw. The day after, the company announced a massive earnings miss but a complete refounding of its business model. The market is completely split. The old company is dead. The new Opendoor 2.0 is a bet on a new CEO, a 2-year timeline to profitability, and a high-speed AI-powered transaction model. The tension is no longer about the housing market, it's about the company's balance sheet. It is a race between a bold new vision and a rapidly dwindling cash pile. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional.